Good afternoon, everyone. My name is Shannon Tompkins, and welcome to the first seminar of the FMA Student Virtual Seminar Series. We realize that COVID-19 has disrupted your college experience, and so we have organized this series to help you stay current with what is going on in the financial markets and economies, and to also keep you connected to the FMA community. To kick off this series, we are excited to have Sam Stovall, Chief Investment Strategist at CFRA, to discuss the investment outlook for the market. If you have any questions during this series, please click on the Q&A button located at the bottom of your screen, as the chat window has been disabled. You can also click the raise your hand button as well. I would like to introduce today's moderator is Professor Rusty Yerkes, who is the chairperson of the FMA Student Chapters Committee, as well as an associate professor of finance at the Brock School of Business at Stanford University. Rusty has research interests in financial markets, investments, financial planning, banking, and financial risk. Rusty?
Thank you, Shannon, and thank you everyone for joining the webinar today. Especially thank you to Sam for being our speaker. Sam currently serves as the Chief Investment Strategist and analyst, publisher, and communicator of CFRA's outlooks for the economy. He recently spoke at the Finance Leaders Conference, FMA Finance Leaders Conference in New York City. Sam is the chair of their investment policy committee. He focuses on market history and valuations, industry momentum strategies. He's also the author of The 7 Rules of Wall Street and writes a weekly sector watch and investment policy committee meeting notes on CFRA's Market Scope Advisor platform. His work is also found in CFRA's flagship weekly newsletter, The Outlook. Prior to joining CFRA, Sam was managing director and chief investment strategist at S&P Global for more than 27 years and served as editor-in-chief at Argus Research, an independent research firm based in New York City. He received an MBA in finance from NYU and a BA in history and education from Muhlenberg College in Allentown, Pennsylvania. Sam, thanks for being with us today. Good afternoon. Take it away.
Hey, Rusty. Well, thank you for that good introduction. Yes, graduate of Muhlenberg College in Allentown, PA. So if anybody in the audience is in the Lehigh Valley, well, here's a shout out to you. But I'm very happy to talk about the 3 R's, retreat, rally, and retest, which is traditionally what the market tends to do whenever we have a bear market scenario, as we have most recently. What I want to discuss today are 3 things. First off, the negatives. I want to acknowledge the fact that we've gone through a very challenging time at this point. We started off the year with elevated investor confidence and market valuations, which I think led us to be vulnerable to a market decline. I think, unfortunately, history did not offer us the best guidance as to what was going to happen with the coronavirus. And as a result, we've ended up with what I call foundering fundamentals, which then have led to plummeting prices. I'll then talk about the positives behind the fiscal and the monetary stimulus, dramatic revelations or revaluations, if you will, of the market and of particular stocks. And then also acknowledge the fact that investors have said, you know what, we're throwing in the kitchen sink, maybe even the bathroom sink and the basement sink when it comes to 2020 earnings. Let's focus on 2021 economic and earnings projections. And then lastly, give you 2 ideas. What can you do as an investor coming out of this bear market environment? One implies that we have seen the worst, and the other one says, no, how do you sort of protect yourself in the period ahead in case we do get the retest of the recent low? So this chart simply reminds us that things were pretty expensive earlier this year. The S&P 500's PE ratio on forward 12-month earnings topped out at 19.6 times. The last time we were that expensive was in the second quarter of 2002. So things just looked very expensive. Investors were pretty complacent, and even measured by looking at the number of sub-industries within the S&P Composite 1500. That's our large cap 500 plus mid cap 400 plus small cap 600. That's essentially S&P's total stock market universe. More than one standard deviation of sub-industries were trading above their 200-day moving average. And like the old Milwaukee beer commercial, their tagline was, "It just doesn't get any better than this." And they were right, because shortly thereafter, the market did get captured up by the negative sentiment around the COVID-19 situation. Now, I always like to say that, as Mark Twain once mentioned, history might not repeat, but it frequently rhymes. But I like to add that, like the singer of the national anthem, sometimes it forgets the words. And that's what happened this time around. That's why so many strategists, myself included, underestimated the impact of the coronavirus early on. Because if we went back almost 20 years, we looked at the market's performance after SARS, swine flu, MERS, Ebola, Zika. We see, what did the market do 30 months out, 60 days out, 30 days, not 30 months, 30 days out, 60 days, 90 days since the first US reported case of those viruses. Every single observation was positive. Even 30 days after the first US case of COVID-19, the market was up more than 1.5%. But then we experienced the glide path of a crowbar, as I like to say, declining more than 30% in the second 30 days, and have continued to fall in the 90-day period. So in a sense, looking toward history, in a sense, gave us a head fake. So what caused the market to do so poorly? Well, looking at recessions going back to World War II is one thing that have caused investors to be a bit concerned about how deep this market sell-off goes. A lot of investors have said, well, Sam, I really want to figure out when we're going to have a recession, because then that'll tell me what to do with the stock market. Well, actually not, because what I'm showing in this slide, the far left-hand grouping, economic recessions, shows when was the peak, when was the trough, how long did this recession last, and what was the change in GDP. You can then see that the S&P 500 earnings, price, and PE ratios during those recessions. The interesting thing is, take a look at the price and look at the very bottom, and you'll see, gee, the market went up 1.3% during economic recessions and was up as many times as it was down. That's because the market anticipates recessions, and that's the right-hand grouping of statistics. Corresponding corrections and bears, we see a peak in the stock market, trough in the stock market, the number of months that decline took, the average being about 13.5 months, average price change being a bit more than 27%. But interesting is that the market tended to anticipate economic slowdowns and contractions by almost 8 months on average. The reason I highlighted the EPS and the PE low is that investors looking at historical earnings declines showed a 10% shortfall and a PE ratio that went down to about 12. If we applied that to today, we would be saying that the bear market would probably rival that of 2000 through 2002 off 48%. So that, I believe, was one of the reasons that the market declined so precipitously. Also, if we take a look at market history, we see that, yes, we were in arguably the longest bull market since World War II, the second largest gain of any bull market since World War II, and the second most expensive bull market since World War II. So if we look at all the bull markets prior to their bear markets, and we say, okay, if they were less than the median, they were called short. If they were greater than the median, they were called long. Ditto for average percent change, less than the median, they were called small, higher than the median, called large, and then the PE ratios at the market top. If it was less than the median, it was called cheap. If it was greater than the median, it was called expensive. Well, we would be in the long, large, expensive camp, and in all cases, we basically saw that the market, on average, declined close to what I call a mega meltdown, or about 40%. And it is not an error that duration of bull and percent of gain have the same number of bull markets on either side of the ledger. That's because how long the bull market is tends to correlate with how much of an advance we tended to see. So history again said, you know what, it's something we should be worried about, that maybe this decline has not fully run its course. But when we look to sector performances, we find that, you know what, on average, the defensive sectors did what they normally do. When we do go into a bear market environment, which is the right-hand grouping, this is the average for all sectors going back to World War II based on their underlying sub-industries. I say that because S&P did not come out with sector-level data until 1990. So anything going back to World War II was based on the average performances of the underlying sub-industries. But you can see healthcare, consumer staples did the best on average. And that's probably not a surprise, because when the going gets tough, the tough go eating, smoking, and drinking. And if they overdo it, they have to go to the doctor. Also, real estate tended to hold up relatively well, as did utilities and materials, primarily because you find gold within that sector. So what happened this time around? Well, consumer staples and healthcare again outperform the market on a relative basis. They're called defensive sectors not because they go up on average, but because they traditionally lose less than the overall market. Communication services, that's basically telecom. And I guess misery loves company, so everybody likes to reach out to everybody else when they're feeling poorly. And so that's why they held up relatively well. Because this was not a repeat of the tech bubble of early 2000, technology actually held up relatively well. Utilities and real estate did poorly this time because prior to this market decline, they were serving as bond substitutes. The yields on these two sectors were so great that investors gravitated toward them who really needed income, who normally would be going to bonds, but went to sectors. And because of that, because of the price decline, once we slipped into a bear market mode, caused these investors to bail out, and as a result, exaggerated the overall price declines. And then ditto for industrials, financials, energy. They usually tend to be underperformers in a bear market. Now, there's good reason why we had this kind of a sector rotation, and that's because from an economic perspective, yeah, it looks as if we are headed for a global economic recession. This is comparative economic projections from Action Economics. First grouping of numbers is as of January 14th, because that was a read just prior to the first recorded case of the coronavirus here in the US. At the time, global GDP was expected to be up 3.3%. All of the major economies were expected to be in positive territory. Indeed, the US up 2.3%. But most recently, we find no, global GDP at best will eke out a 0.5% gain, primarily because of the support in general from the emerging economies, and in particular from China. But the advanced economies are expected to be down 2.7%. The US is expected to be off 3% for all of this year. Europe doing even worse, minus 3.2%. So yes, you can see that from an economic projection, it was at best a coincident indicator, if not a lagging indicator. So the market tends to anticipate changes in fundamentals. So prices lead fundamentals is the old adage, and here is a perfect example of it doing just that. When we break the year into quarters, we find that our economists are anticipating a V-shaped decline and then recovery. So first quarter GDP will likely show a minus 4.5%. as compared with a gain of 1.9% that was anticipated on January 14th. Second quarter is now expected to be off 26%, and that number changes almost every other day versus the 2.6% advance expected on January 14th. Yet third quarter, our economists think that we will see a pretty sharp percent, up 10% in the fourth quarter, 2021, with all of 2021 likely to show a gain of more than 5%. So the economists are looking for a V-shaped recovery. Equity analysts, however, are looking more for an elongated U recovery. Looking beyond the valley, yeah, maybe that's one reason why we did have a pretty sharp advance in equity prices over the last couple of weeks, because when you look to 2020 estimates, those are the gray bars, they're all negative numbers, down almost 17% for the S&P 500, down almost 23% for developed international economies or stock markets, and then minus 6% for emerging markets. But then the orange bars heading into 2021, expected earnings increases of more than 24%, 33%, 22% for the US developed international and emerging markets. Yet it's going to be a pretty tough row to hoe at this point in terms of 2020, because look at all of the negative numbers. And the trough is likely to be in the second quarter with a greater than 30% decline. Only utility is expected to show a year-on-year increase. And believe me when I say that these estimates continue to tumble every time I open up my linking spreadsheet. 2020 now is expected to show a 17% earnings decline, with positive reports only for consumer staples and utilities. But if you look to 2021, optimism reigns supreme, because expectations are for a near 25% year-on-year increase. So I think that is what's giving investors some optimism as we move forward. Yet the question is, where will prices be? Right now, we see the horizontal bar. Recently, we had 2823 on the S&P 500. Well, based on 2020 estimates, we would have to see a PE ratio of 18, 19, 20 times in order to get the S&P up above the level where we are today. So we have a long way to go before we can really be overly optimistic as to what is going to happen to the market in the next several months for this full calendar year. So based on PE ratios applied to earnings estimates, things might still be a bit challenging for all of 2020. But because of this optimism, we have seen since this market bottomed on March 23rd, a 29% gain in the S&P 500 through last Friday. Every sector in the S&P was in positive territory, all of them in double digits. We had the value index outperform the growth index, not by much, but at least show a slight favoritism. Mid caps and small caps were up more than 20%. And every sub-industry but one was in positive territory in this period since the March 23rd low. So you can see that there can be very sharp rallies that take place within bear market environments. So now the real question is, did the low on March 23rd signal the end of this bear market? History would say no, that if you look to the 73, 74 mega meltdown, you look to 2000 through 02, 2007 through 09, we traditionally had at least one 20% plus rally within that bear market. Case in point, 2008, on November 20th, the S&P 500 was down 52%. However, through January 3rd, we gained 25%. And a lot of investors thought, oh, here we go, we're back to the races, only to have the market turn back around again and set an even lower low off 57% as of March 9th. So we could be seeing something similar this time around. I emphasize the word could because something has happened recently that did not happen in prior bear markets. And that is the very swift and decisive action by the central bank primarily, but also some grudging approval between the two parties in government to actually put some monetary and fiscal stimulus to work right away, whether it's in the form of cutting interest rates to zero, resurrecting the money market mutual fund liquidity facility to shore up money markets, whether it's buying assets, and it's not just the US central bank, it's also the ECB, European Central Bank, the Bank of England, the Switzerland National Bank, etc., that was done in order to shore up what is likely to be a very challenging time. Also, investors were encouraged by how attractively valued the market and sectors were at the most recent low. The S&P 500, which is the blue shading on the bottom, the first grouping shows absolute PE ratios, meaning what is the PE today versus its own average over the last 20 years. On the right-hand side, we have relative PEs, meaning what's the PE of a sector as compared with the PE of the market over time, and whether it's trading at a premium or a discount. On an absolute basis, we see double-digit discounts for financials, healthcare, industrials, tech, materials, and real estate. And on a relative basis, we see double-digit discounts for financials, healthcare, and industrials. So many investors who have long-term time horizons look to these valuations and say, you know what, I might not get a second chance, so let me start to do some nibbling along the way. Of course, the question that investors typically ask is the worst behind us? This is simply a rolling 15-day average of intraday volatility. So meaning all I simply did was downloaded Yahoo Finance data on the S&P 500 showing the high and the low, and then I simply did a daily percent change, and then I averaged that over a 15-day period and plotted that rolling average. And you can see that we had stalagmite type peaks in 87, 98, 02, 08, etc. So typically showing that the market tended to bottom about a month after we had this spike. The market actually bottomed in early December of 87. Now you might say, well, wait a minute, Sam, October 28th of 08 was nowhere near the bottom. Well, for a lot of individual stocks, November 20th was the bottom, and that March 9th of 2009 was a successful retest of that November 20th low. So in some ways, you could say for a majority of individual stocks, it was a very good indicator. Well, this time around, that 15-day peak occurred on March 27th and has been coming down quite sharply ever since. And so now we are actually, if I had updated this slide as of last night, we would actually be back below 2 standard deviations from the mean, definitely showing that the volatility has come down, implying, but obviously not guaranteeing, that the worst is likely behind us. So what do you do with all this information? It's nice to be aware of history, but how do you put history to work for you? How do you make some money off of it? Well, one thing is, coming from the New York area, I love the different accents. And one of them is if somebody were asked to pronounce worst to first, it would probably come out as worst to first. So basically, the worst performing sectors and sub-industries on the way down tended to become the best performers in the 6 months after that ultimate bottom. So I went back to 1990, looking at bear markets and near bear markets. What was the price change during that decline? And then what happened 6 months after the bottom? What happened to the market? Average gain was almost 29% 6 months later. The point difference between, well, what if I owned the 3 worst performing sectors as of the market bottom on 1990, the market bottom of 1998, etc. I owned those 3 worst sectors in equal proportions and held them for the coming 6-month period. How would I have done? Well, on average, you would have outperformed the S&P 500 by 13 percentage points. So in 1990, while the S&P was up 27.8%, the sectors beat the market by 17.6 percentage points. The 10 worst performing sectors during the bear market of 1990, 6 months after that bottom, outperformed the market by 50 percentage points. So meaning it was up 77.9% in that 6-month period after the bottom occurred in 1990. 1998, sector beat the market, but the 10 sub-industries underperformed even though they were still positive. So this shows you on average that the sub-industries within the S&P beat the market itself by almost 33 percentage points. So now we come to the drum roll. What were the 3 worst performing sectors? Well, they were energy, financials, and industrials. Energy, not a surprise at all, down 56%. Financials off 43%, industrials off almost 42%, as compared with a near 34% decline for the S&P 500. So if this worst to first strategy holds true, there's no guarantee it will, these 3 sectors together as a group should outperform the market's performance between now and the end of September of this year. Also, what were the 10 worst performing sub-industries from March 23rd or from February 19th through March 23rd? We had airlines, now they're in alphabetical order here. We show airlines, department stores, hotels, household appliances, motorcycles, and 5 different energy areas that did the worst. So what I did was I went on to our Market Scope Advisor platform and said, show me a representative stock within that sub-industry that has the highest analyst ranking. Like a movie or a restaurant review, 5-star is the best, 1-star is the worst. And so I showed those stocks that had the best overall ranking within the category. So again, this could be an idea for an investor who has a little bit more risk tolerance than, let's say, others, to see whether they can make some money in the coming 6-month period. I, however, am one of those investors who can be so indecisive that my favorite color is plaid. So what I like to do is I like to embrace a rules-based investment approach. My book, The 7 Rules of Wall Street, goes through 7 rules of thumb, old Wall Street sayings that still hold true today. One of them being sell in May and then go away. Actually, I tell investors don't sell in May, don't go away, don't retreat, but rather rotate. Gravitate toward those areas that tend to do the best in the May through October period while always remaining in the stock market, primarily because if markets advance in this period, a rising tide tends to lift all boats, and the defensive sectors will likely do well. Even though they might underperform, they'll do better than being in cash. This bar chart shows that since 1990, when S&P came out with sector level indices, while the market was up 1.8% on average in May through October, the average performance for the consumer staples and healthcare sectors was 4.6%. So we saw significant outperformance by the defensive sectors in that May through October period. I think a lot of it has to do with capital inflows, but in this kind of a time frame, what we find is that maybe the benefit actually will be because investors are worried that we could have a significant retest of the prior low. And even if the March 23rd low was the low for this bear market, history says that 2 out of every 3 times the sell in May strategy, the emphasizing of consumer staples and healthcare sectors, went on to beat the market anyway in the May through October period. So here I show the bear markets or near bear markets since 1990. What was the decline of that bear market? And then how did the S&P 500 perform in the subsequent May through October period, along with the average performance for CS and HC, meaning consumer staples and healthcare. And then if the consumer staples and healthcare average beat the market, I gave it a 1. If it did not beat the market, I gave it a 0. So you can see on the bottom that on average, the market gained almost 6%. The consumer staples and healthcare gained more than 9%, and the strategy beat the market 2 out of every 3 times. Granted, this is not a very big sample size, but hey, it's better than nothing. Also, looking back to 1990 when this strategy got started, the blue bars represent the benchmark for the S&P 500. The orange bars represent the strategy of being cyclical November through April, being defensive May through October. So every 6 months going back and forth, you can see the level of outperformance, whether you're looking at the most recently completed 6-month period, as well as the most recent 12 months, 3, 5, 10, 20 years, and since inception. There is an ETF based on this strategy. The ticker is SZNE, Sam, Zebra, Nancy, Edward. To learn more about it, please go to Pacer-CFRA blue URL at the bottom right of this screen. Lastly, this is a question that Rusty asked me earlier today, and I thought, you know what, this might be a good slide to show people participating in this presentation anyway. No matter what happens, it could take a while for us to get back to break even. What I show here are all of the bear markets since World War II. I show how fast did it take in terms of calendar days to go down to the minus 10% threshold, the minus 20% threshold, how many days to actually hit the final bottom, and then what was the total decline for the bear market. Interesting that the average decline of 33% is essentially what we experienced most recently. What was the average give back in terms of this bear market relative to the prior bull market? On average, it tended to give back 70% of what was gained in the prior bull market. And it took about 25 months on average to get back to break even. Now, if you break that down into what I call the garden variety bear markets, those that are 20 to 40%, well, it took a little more than a year, 14 months to get back to break even. But mega meltdowns, meaning those of 40% or more, and we've had 3 of those since World War II, it took us almost 5 years to get back to break even. So Rusty, I'll stop adding hot air to the room. This is the extent of my formal presentation. Anybody who wants to learn more about the company CFRA Research can go to our website, CFRAresearch.com. We are actually offering a complimentary access to our website for 90 days to help you get through the coronavirus at home. Just go on to the website at the bottom in that bold blue bar, and you can sign up for a free access for 3 months. So Rusty, I'll turn it back over to you, and thanks everybody for listening.
All right, thank you, Sam. We do have questions coming in now. I would like to remind the participants, if you would like to ask a question at the bottom of your screen, if you would click on Q&A, you have an option there to type in a question. Sam, our first question comes from Chris Rayback, and Chris is wondering, how would the worst to first strategy work with governmental intervention? For example, if hospitality weren't reopening for 12 months based on government policies, would that essentially take away their opportunity to bounce back?
Well, Chris, that's a good question. I always get a question of, well, what if this, what if that? Mainly because it just shows people are listening and they're thinking of different scenarios. Interesting, but this is one of the few times that we've actually had government intervention. So the historical data would show you what would happen if you did not have government intervention, because you really didn't in the prior bear markets and near bear markets. So it would show basically that investors are opportunists, and investors basically are saying, look, those companies that were priced to go out of business did not. are the ones that I want to invest in because they're the ones likely to bounce back the greatest. They might not be the longest term opportunities, and they might not be getting back to break even. Case in point, financials were up almost 150% a year after the market bottom in March 9th of 2009, but they'd already fallen 86%. So they did not get back to break even by any stretch. So it's really just investors looking to take advantage of opportunities, and the historical data really shows what happened without a lot of government intervention preceding that.
Sam, our next question comes from Bhavik Parikh, and Bhavik is wondering what would happen to your analysis if there's a second wave of COVID-19 in a few months?
Good question, Bhavik. Actually, because of that potential of a second wave, and because of the potential that we are simply going through a rally period after the retreat period, but we have yet to go through the retest. That's why I don't claim that we are in a new bull market. If you recall my slide, I showed back here that the market was up 25%, or I should say 28.5%, all sectors in positive territory, all but one sub-industry in positive territory. You might say, oh, that looks like a bull market to me. Well, not so fast, because I think you need to not go below the prior low within a 6-month time frame in order to, in a sense, solidify the fact that we are in a bull market. So if we do end up going into a new bear market mode, if we do have a retest, if you will, of the prior low because of the reintroduction of the coronavirus, whether it's because we opened up our economy too quickly, or whether because the coronavirus, in a sense, goes to sleep during the warmer weather period and then re-emerges in the cooler weather like the flu itself. Yeah, that could indicate that we simply had about a 6-month respite before we plunge right back into the thick of things.
Any other questions out there from the participants?
I see a question there.
Sam, our next question comes from Ford Malman from Samford University. Ford is asking about United Airlines. They're looking to issue 39 million new shares to raise money to help get through this period. How would that affect the outlook of them, considering they are in bottom industry?
Well, because I am sharing my screen, I'm still sharing my screen, right? Let me use this as an opportunity to show you our Market Scope Advisor platform. Can you guys see that? We have United Airlines ranked hold at this point. Of the airlines that we favor, Delta had been our favorite as a hold. If you were wondering, gee, I wonder which stocks in the airline industry, other than Alaska Air, which I had shown you before, we could go to a stock screener. We could say, well, I want to see those sub-industries, those sectors, 5 stars or 4s, which are basically our buy and strong buy recommendations. I want to look at airlines and maybe within the S&P 500. What do I get? Well, Alaska Air is the only one ranked 4 stars. In terms of the specific question about what would a company need to do in order to go from a hold to a buy, those are things that the analyst would know better than I. That's well above my pay grade. But obviously, anything that a company would do, such as raising dividends, such as buying back shares, such as reducing costs or coming up with new ways of making revenues, those are the things that are going to cause investor interest in that stock, because the reason you own a stock is because you want a cut of the action. What is the action? The action is earnings. How do you get a cut of that action? Well, you get it in the form of dividends, or you get it in the form of higher share prices. And sometimes higher prices can be on a relative basis, meaning you simply fall less than the peer group or the market as a whole. So right now, our analysts are only optimistic on Alaska Air, at least within the 500. Let me just see whether we have any that are in the smaller camps. Survey says, nope, Alaska is all you're going to get.
Hey, Sam, your slide presentation is still on the, is still showing the PowerPoint. Are you able to perhaps toggle over to the market scope?
Oh, yes. Okay. So much for me for thinking I knew what I was doing. Okay. So let's see.
Maybe try share screen down at the bottom again, and you might have to select a different window.
Okay. Mm-hmm. Okay. Maybe here's my ignorance that, oh, more. No, unfortunately, I can't really, I'm not getting this. Oh, new share. Yep. Okay. Here we go. That's my.
No worries if you can't. We can move on with the question.
All right. Yeah, no, that would have been nice. I thought that I was showing it when I was doing it, but you know, my
No worries.
apologies.
So next question from Jason. Sam, do you still stand behind your year-end 2020 S&P 500 projection of 3435?
For right now, yes, I do. And the reason is that, first off, because, you know, when we're dealing with a situation like today, you know, we're dealing with something that changes every day. First off, how could I be adding any kind of value if I felt that, you know, every day I'm going to be changing my year-end target? Second, I think that the question is, okay, what kind of value could I add by simply saying, I'll take off my target and just have to be announced. When also take a look at, now, Rusty, can you see the slide again of the recovery time for bear markets since World War II? Okay, I can hear you nod your head. So if you take a look at months to break even, well, you know, looking at 1990, it took only 4 months to get back to break even. Took only 3 months after the 82 bear market. Took only 7 months. You know, there is a possibility that we get back to break even. And if you remember, break even was a new all-time high. That could occur in a very, very quick period of time if the investors believe that the worst is behind us and that we are headed toward an expanding economy, et cetera. Also, what we find is that the average gain 12 months after, just 12 months after bear markets is an advance of close to 40% since 1929. Interesting, but when you then take a look at what is the target price differential, meaning what is the price of a stock today versus our analysts' potential target price 12 months from now, that weighted average difference is 20%, which equates to 34.35. So yes, 34.35 might sound pretty optimistic, a 20% advance from where we were most recently. And so I'm going to stick with it, mainly also because it's now a 12-month target, meaning the end of April of 2021. I always do a 12-month target. I don't just do an end-of-year target and then readjust that because, I mean, I remember being on the CNBC or Fox or Yahoo, and we're like 2 weeks away from the end of the year, and they were always saying, have you readjusted your end-of-year target? What benefit is there to have a 2-week target? So that's why I say I use a 12-month target, because most investors are trying to look down the road 6, 9, 12 months. And that's exactly what our analysts do when they make their buy, hold, and sell recommendations. It is based on a 12-month time horizon. So my target price for the 500 is meant to offer them some guidance as to, you know, what to aim for.
All right, very good. All are there any secure investments during this coronavirus scenario, and which stocks might you recommend under those conditions?
Well, if Sir Isaac Newton had a fourth law, it would be for every level of return, there would be an equal level of risk. And so basically, if you're looking for security, you're probably not going to get much in the way of return. And you might say, well, at that point, that's fine. At this point, that is fine. Well, what is interesting is that we traditionally find that the best alternative asset to equities during a bear market is bonds. If you look to TLT, the long bond, during this market decline, it was up about 14%, while the market itself was down 33%. Take a look at 2000 through in 2008, while the S&P was off 38%, long-term treasuries were up 24%. So long-term treasuries tend to be your easiest diversifying asset class. A lot of people confuse correlation with quantity, and they say, well, Sam, I had exposure to large, mid, small US stocks, developed international, emerging markets. I even had REITs and commodities, and I still got crushed. I was diversified, wasn't I? And the answer is no, because all of those are economically sensitive. They all tend to have a correlation of one during bear markets. It's the treasuries that, and maybe to a lesser extent gold, that tend to offer negative correlations to equities during those times. So, if you're looking for some ballast other than maybe a hedge fund, I would look simply to longer-term treasuries, and they tend to smooth out the return over the long haul.
Sam, our next question comes from Tyler Saponic. The oil sector seems to continue to go down. Will we see the comeback that other energy and industrials might see?
I think my internet caused you to freeze up.
The oil sector seems to continue to go down. Will we see a comeback that other energy and industrials might see?
Well, industrials, materials, energy are very highly correlated to one another because they are, mainly because they tend to be beneficiaries of late cycle economic activities. Also, they are very international in scope. They were the ones that were hit the hardest ever since February of 2017, 2018, when we started the trade war with China. So they've been in a downtrend ever since, and now with the coronavirus, they've taken it particularly hard on the chin. So should we get investors feel that the worst is behind us, then, as I had said earlier, that many of these groups do have double-digit discounts to absolute and relative PEs, and with energy having lost as much as it has, it could end up bouncing back. Probably not as much as industrials, financials, and materials, mainly because with commodities, you deal with the actual commodity itself in a supply-demand balance kind of a mode. And the problem with oil is it's stuck in between a rock and a hard place, that basically we've just had too much supply because of the slowdown in global economic growth over the last couple of years, because of the trade war with China, because of the price war between Saudi Arabia and Russia, and then now with the shelter-in-place order globally, it's also caused a dramatic decline in demand for oil. So as a result, too much oil out there, too few people looking to buy oil. It's going to take some time for all of that surplus supply to be worked off. And so while prices might move higher in tandem with or slightly ahead of the overall market, it might not bounce as quickly as, let's say, the financials, industrials, and materials might.
Another question here, Sam. You mentioned the market may not have bottomed, but some stocks, however, may have. Is there any way to tease out which individual stocks might have already bottomed?
Well, here's a good example for or exercise for somebody who wants to be a technician, because many of these patterns can be seen in technical formations. You know, whether we're looking at double bottoms, reverse head and shoulders, we're looking at lower lows, so forth and so on. I don't have a list of those that I believe have already bottomed and are working their way higher. I mean, technically, the whole market looks like that. Nobody knows for sure. It will be when we do go through the retest, and if you find that whether you look to the relative strength indicator, you look to stochastics, you look to the overall trend lines themselves, and find that in this retest, if it does not go below the prior low, whether it's for the market, the sector, the sub-industry, or the stock, then you can say that it was a successful retest, and those items are likely to work their way higher.
Another question here from Jamal. Some big companies, for example, Amazon, Netflix, have profited from the crisis. Will they be able to keep their evolution, or at least an important part of it, through long-term change in consumer behavior, or are we simply not witnessing the new normal in these cases?
No, I think that this is an example of we are experiencing the new normal, realizing that we are very much in a digital age, that it's the digital providers of information, of products, of services that are likely to be in demand in the future. And we're seeing it pronounced right now. Probably give you an idea of those companies and their services and products that will be in demand should we end up with a second round of coronavirus in the fall and winter of this year. So I would tend to say, like, why would people stop interacting from a digital perspective? Why would we all want to get back on an airplane to fly around the country to speak to audiences that are half the size of what we could get by being on a webinar? So, you know, I think that a lot of people are learning today, you know what, we can have a much wider reach and also stay at home, be comfortably dressed, at least, you know, below the tie line, and, you know, still get our message out to the greatest number of people without spending a lot of money or time. So I would tend to say that the period right now sort of allows you to laser beam focus on those companies that are likely to be the outperformers once we get back to normal.
We maybe have time for one or two more questions. Do you think COVID-19 is the recession that we've been expecting after a 10-year bull market, or do you think that there would be another recession that occurs in the next, say, 2 years?
Nobody knows for sure, but who knows what causes the recession? That's why they're called black swans, because they are few and far between. I always like to say that the market usually responds to unanticipated events, and they are typically hard to anticipate. So you don't really know for sure what is going to trigger it. Whether it's going to be in the 73, OPEC turning off the oil, in the early 2000s, technology being thought of as a bargain, even though it was trading at 60 times projected earnings, et cetera. So yeah, I definitely think that it was, in a sense, a correction waiting for a catalyst. It was a contraction in the economy waiting for a catalyst, and the coronavirus was that catalyst. What makes it atypical is the speed with which we saw the decline in the economy, and will likely continue to see the decline in the economy, ditto with corporate earnings. Normally, it takes 9 months to go from an all-time high to the minus 20% threshold. That's how long it took us back in 2007 and into 2008. Took us 9 months to go from early October to early July. This time around, took us less than a month, 22 calendar days. So the only thing really different this time around is the speed with which the decline occurred. But what happens in recessions, what happens in bear markets, is the resetting of the dials. And whether it's because of a corona recession, oil recession, financial recession, technology recession, it doesn't matter. So long as the dials get reset, then in a sense, we get back to a new starting point.
Sam, there are a couple of questions here from German Diaz and Eric Bartos about the renewable energy sector and how they might be impacted since the price of oil has dropped so low. For example, like the Tesla electric cars and so forth.
Well, it is funny, but whenever oil prices go up, that's when the Hummers would, in a sense, go to their graveyards, when the large gas guzzlers would become out of favor, when the smaller, more fuel-efficient companies would come into favor. It's all economics. So right now, with gasoline prices at about $1.80 per gallon in the Northeast, a lot of people aren't really too worried about renewables. Of course, I feel pretty encouraged when I see the air pollution readings over the US, over China, over the world, and see them having been reduced quite precipitously because everybody is staying at home. That gives you hope for the future that the world is a self-regulating mechanism where it can heal itself given enough time. Also like seeing all the wild animals who tend to wander through the streets of the cities because there are no humans out there. They're better than most of the wild animals I normally see on New York City streets at night. But in general, I would tend to say that yes, because oil prices are now so low, that could put alternative energy on the back burner for a while.
Sam, our last question comes from Qingping Zhang, asking whether there's any fiscal and monetary policy stimulus left after what's already been done.
Oh, absolutely. The government is in charge of its own printing press. So yes, it can pretty much print whatever it wants to serve as stimulus. And right now, the federal, the Fed would like for inflation to be picking up. And it looks like something we're not going to be experiencing for a while. CPI is expected to be deflationary, not disinflationary in the near term. So typically the printing of money, the dropping of it from helicopters, et cetera, is regarded as being inflationary. And right now the Fed thinks that would probably be a good thing. So nope, if you control the printing press, you can pretty much stimulate the economy as much as you see fit.
Sam, let me follow up on that briefly. Could you say more about your outlook for inflation?
Well, our outlook for inflation is that it will likely remain under the 2% threshold that the Fed would like over the next that's their time horizon, if you will. Their goal is to see inflation at about 2% or higher. Because then you don't cause people to say, well, I'm going to wait and buy something later because it'll end up being even cheaper. Right now, in terms of core CPI, our expectations are about 1.7% for the remainder of this year. When you look to the PCE, personal consumption expenditure measurement, which is what the Federal Reserve looks at, on a core year-on-year basis, we're hovering at about 1.5%. If you take a look at this data and you go into the coming calendar years, well, then you're also looking for inflation to be relatively low. Right now, our forecast for core CPI is only 1.8% for all of this year. Core PCE 1.5% for this year, and then we eke up to about 1.9% for 2021. So our economists are not looking for a surge in inflation in the coming year.
Any concerns about negative interest rates or deflation?
Well, concerns if we were to get that, absolutely. The Fed knows how to fight inflation. It does not know how to fight, or at least has not had a lot of practice with fighting deflation. In the 1930s, deflation was the primary concern. If prices continue to spiral downward, people say, well, I'm not going to buy a new car this month. I'll wait for next month. It might be cheaper. Maybe I'll wait 6 months. It'll be even cheaper than that. I won't take out an annual contract for rentals. I'll do it month to month because every month I could get my apartment at a cheaper price. So that is what happened back in the 1930s, and it creates a downward spiral in terms of mindset and in terms of prices. And as a result, it's those companies with very high debt levels that tend to take it the hardest, because now they have to lower their prices in order to sell more goods and services to meet the interest fees that they have to pay off every month. So if you have a lot of debt, then that ends up acting like a weight, like an anchor that would cause the company drag as they try to grow their way out of this kind of an environment. So disinflation we've had to deal with. Deflation is something that the Fed definitely does not want to have to fight anytime soon.
Sam, this has been fantastic. I'd like to thank you and all our participants for joining us today. Just as a reminder, there will be a video recording posted on FMA's YouTube channel this week. And also as a reminder, CFRA is offering all seminar participants a free 90-day access to their newsletter, The Outlook, which offers investment research insights, fund reports, and proprietary ratings. More details about this will be in a follow-up email. Also, please keep an eye on your email and social media for future seminars similar to this. And then I'd like to thank FMA, Michelle, Shannon, and Dawn for coordinating everything behind the scenes. Fantastic job to you all as we explore new ways to try to add value and provide students for our services for our FMA student members. So I think if there are no other questions or comments, that this will conclude our call for today. Thanks again, everyone. We'll talk to you again soon.